Bloomberg Audio Studios.
Podcasts, radio, news.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
On this week's podcast, I sit down with Lakshman Achuthan. He is the co-founder of ECRI, the Economic Cycle Research Institute. I've known Lakshman for, 15 years, almost 20 years. And I've always found his take on the world of economics and recessions and inflation and employment just fascinating and unique and different from what everybody else does. It is very specifically data-driven, based on a model that was originally co-developed by Professor Geoffrey Moore. And I don't know how else to describe it other than you're looking at data, you're looking at leading indicators of different lengths as well as coincidental indicators, and you're trying to figure out when cycles turn. Hey, anybody can predict a trend. You just stay with it until it ends, but catching the turns is much more challenging. They've put together a tremendous track record over the past 30 years, better than just about everybody. Nobody's perfect, but they've gotten more of the turns and more of the major cycle turns than anybody else. And that's why their research is read by not just big investment houses and companies, but sovereign banks and governments around the world. I thought this conversation was absolutely fascinating, and I think you will also. With no further ado, my discussion with Lakshman Achuthan. Lakshman, welcome back to Bloomberg.
Well, it's wonderful to be back, and congratulations on this series over all these years.
10 years. You were in the first year's shows, which I have to be honest, are pretty unlistenable. I go back and listen to them, and you could tell I'm just like a puppy dog of caffeine and adrenaline. But thank you so much for coming back, and we'll do this the right way this time. So let's start out with a little bit of your background. Had already graduated college and grad school. You were doing some work at Columbia with Geoffrey Moore. Tell us a little bit about the sort of research projects you were doing back in the 1990s.
Right. So thank you, and pleasure to be here with you. And thanks for the question. I had the good fortune or interesting timing of starting with Dr. Moore right when the 1990-91 recession was happening. So it's very interesting, and what my whole life's work is around business cycles. So this was extremely interesting to see in real time rather than reading it in a history book. And what I found so interesting about his work was it was applied economics, and it brought some cohesiveness to the way economies work around the world, free market-oriented economies. Because I'd done some earlier traveling around Europe. I saw all these different economies and different currencies, and I wondered, how does this all fit together? And he had kind of a framework for it, the makings of one, which I found very interesting. One key thing we were doing back then was if cycles are transmitted internationally. That was a big aspect of what we were working on. What
sort of cycles?
Business cycles.
How are business cycles transmitted from country to country?
Yeah, so if Europe goes into recession, what's the impact on the U.S. or vice versa, and or Japan, or these were all the big economies then. And how do they get transmitted? What are the impacts we have? How does it, what cycles are there that we all are participating in around the world, and which ones are slightly more local to specific economies? So that's a big issue.
Can we assume trade is a big impact into those as a transmission mechanism, or is it more nuanced than that?
It's always more nuanced, but trade is a big one. Trade is a big one. Markets are a big one, and a lot of people take their cue from what's going on in the U.S. So there's an outsized impact of the U.S. market globally, even in local economies around the world. And it's very much in the goods and trades area where we've all taken little spots in the manufacturing floor, and so we're linked that way, and for better or worse, can impact us. And meanwhile, our domestic economies may be doing something different.
So everybody thinks of the dollar as our exorbitant privilege, but you're implying U.S. stock markets are really a giant exorbitant privilege to the U.S. It is part of what drives the global economy?
Yes, and here I work with a lot of different, we at ECRI work with a lot of different users of our material. And so to keep it simple, some are investment managers and some are C-suite kind of business managers. And on the investment management side, even if you're an investment manager abroad, you're going to have probably a decent sized investment in the United States market. And that's one of the factors that goes into the big mix. There's also all kinds of other things in the mix. But transmissions of cycles internationally was a key thing early on. I think one of the bigger things that's critical today that we were working on then was the relationship of really three major aspects of the economy from a cyclical perspective. There's cycles in growth, which can be at extremes when they contract, can be business cycles, recessions and expansions. There's cycles in employment, which are related but distinct. They're actually identifiable in different cycles in employment. And there's a third cycle, a third aspect, which is cycles in inflation. And being able to see that, just to understand the lay of the land of cycles in free market-oriented economies, is a huge thing. Just being aware that that's the pool that we're all swimming in is really important for getting at some of the nuances of what's going on in the economy. So understanding those three key aspects of the economy and not forcing them, and our process doesn't force them to directly relate to one another, gives us a great deal of flexibility in understanding what's happening.
Growth, employment, and inflation. If you have a handle on those three
aspects,
you really understand what's going on in the economy.
I think, I don't know that really at the end there's stuff I still don't know, but I think you have a pretty good handle on the nuances. Like, how can it be that one's going up and the other's going down? Because you have to tell the story. What's happening of what you're seeing? Understanding that these three cycles, which are related but distinct, in and of itself is a big leap forward in that understanding.
It was kind of fascinating in 2022 and to a lesser degree 23, watching the kind of prior generation, the old school 1970s economists, get the growth, employment, and inflation picture completely wrong. It seemed like they defaulted back to the 1973-74 cycle and had a hard time. We were talking earlier about the Paul Graham quote, all experts are experts in the way the world used to be. But, when people come out, probably most famously Lawrence Summers says you need to have unemployment to shoot up to 10% to kill inflation. Turned out that wasn't the case, was it?
Well, no, it's not the case. And again, it's because these cycles, while related, are distinct. There's more inflation cycles than business cycles, for example.
Right.
Probably a little fewer employment cycles than inflation cycles. Those will match up a bit more to business and growth cycles. But even allowing or understanding that these things can go in different directions is critical. 23, 24 is very interesting because first, let's remember that there was a huge, massive inflation cycle upturn, right? It's giant in 2020.
Biggest one we've seen, much bigger than the one before the financial crisis.
And one of the things, just even forget about forecasting or saying what's going to happen. One of the things that's critical to understand is that inflation is cyclical. I know those are easy words for us to say and talk about on this program, but fundamentally, a lot of models are not built that way. A lot of policy is not driven that way. In fact, you could still see the antecedents of that today in the markets and the way people are thinking. Hey, inflation's coming down. Yeah, sure, because it went to the moon. And yeah, it's coming down from the moon. Okay, so we could agree on that. But does it just keep going down? How do you know? Does it go down and stay flat at your target? Yeah, I don't know. Where have you seen that happen before? If you study inflation over decades and have a cyclical vantage point on it, what you'll see is that it doesn't go down to some number and hang out. It likes to cycle. It likes to go up and it likes to go down. And the odds, therefore, in my mind, of it going down and hanging out at some prescribed number are pretty low. And so therefore, we look at leading indicators of the inflation cycle. The future inflation gauge is what we call our leading indicator. And it tries to tell us, is there going to be a turn? So we watch for that. In a very simplified way, that's what we're doing when we look at cycles.
Let's look at the 2020s, but within the context of what came before the 2010s. The Fed talked pretty continuously in the prior decade about the challenge of getting inflation up to 2%. We were in a disinflationary environment, sometimes a deflationary environment. Around a lot of the world, interest rates had gone negative, and that decade seemed to be our risk is now deflation, like Japan. That's what we have to be on guard. Suddenly, the decade flips, the pandemic starts, the CARES Act, the first one was the biggest fiscal stimulus since World War II, 10% of GDP. The whole regime changes, and now we're off in a completely different cycle? Or is that just making it too simple and easy?
No, something has changed. Let's agree on that. Something happened.
No doubt.
Something happened. Okay. But if we're going to talk about the 2010s, in a way, what you're dealing with is there was a bit of a freak out after the financial crisis.
Right. So when we talk about the previous decade, then for context, you got to look at the decade
so there's
before.
There's a
this
bit of
history thing.
Yeah, this history thing. So in April of 2020, there was a G20 meeting in London, and the primary concern was depression.
Right.
Okay. I mean, that's what the main headline was. And so, and actually we were beginning our business cycle recovery right around then. It was going to start in the summer. But nevertheless, the powers that be were focused on depression, and it was almost like you don't let any good crisis go to waste, that quote, right? So here we have massive stimulus put in all these different programs, and we go off on this spending spree. And it wasn't just us, right? It
was around the world.
It was around the world, and in particular in China, where I love this statistic. In 3 years, from 2011 to 13, they poured more cement in China than the United States did in the entire 20th century.
Right. I recall that.
Which is insane.
But the fascinating thing about the 2010s was that while Asia, and China in particular, were engaging in a massive fiscal spend, there was austerity in the UK, there was weak spending in Europe, and the U.S., it was pretty much all monetary, no fiscal.
All monetary, no fiscal. So you have the stalemate or whatever, logjam in Washington. I agree that you have monetary, the lift is being done on the monetary side of policy.
100%.
But the result of this whole thing, and now I'm painting in broad brushstrokes, U.S. inflation, services inflation is actually positive for much of the decade. It's really goods disinflation, which is ripping stuff down, to which monetary policy is saying, we're going to somehow combat this with more stimulus or easiness or whatever, and it doesn't really work that way. Right? But it inflated some things.
Right. If low rates weren't the cause of inflation, well, why would you think high rates are going to impact? There's got to be some causality between the solution and the outcome.
And so we have this we have this China price being set. We have the supply chains being optimized for that, as opposed to robustness, which came back with a vengeance once things went off the rails with the supply chains when COVID hit. So with I'm skipping over a lot of this QE kind of stuff that we were really mired in that.
Quantitative easing during the 2010s. We now have the opposite of a quantitative tightening.
Well, to a degree. We have a little bit of it. We'll see how far it goes. It was very fascinating. I'm sorry I'm jumping around here.
No,
but
this is interesting.
It was very fascinating because Japan the other day, the Bank of Japan raised rates for the
first time in
17 years.
Right.
Okay, so it's a big deal, right? I mean, it was a minuscule rate rise, but and they're doing this because they have a little bit of inflation, which they haven't seen in a long time,
right?
And so they're like, "Oh, okay, we're going to respond to that," but they actually can't. It's a paper tiger. They can't really raise rates,
right?
Because the country is so indebted that they can't service any higher rates.
So they've been the poster child to the argument, who cares about deficits?
Yeah.
Because they've been running deficits for forever, in part because of their demographic problems, rescued in large part because they've been an exporter since the end of World War II.
Yeah. Can you just print money and run deficits of very large sizes forever? And to many of us, we would say, well, it doesn't sound like that could work. But we're pushing it.
And yet, since I graduated college in the 1980s, all I have heard is, if the U.S. runs big deficits, well, that'll be the demise of the dollar. Inflation will run amok. You'll crowd out private capital. No one will lend money to Uncle Sam. And all the things that I have been told are the manifestation of deficits, none of them have come true.
Yeah.
At a certain point, I think perhaps something goes wrong. But after being wrong for 50 years, it kind of makes me look at the people warning about deficits and saying, I don't know, you've had half a century to get this right, and everything you've said has been false. Why should I listen to you today? Yeah. Well, this time we're serious.
Yeah.
It's weird, isn't it?
It's a really interesting question. So post-GFC, we ran up the debt towards $10 trillion, maybe just under $10 trillion. And then post-COVID, we're north of 30 in the U.S., right? So who knows? I don't know. Could we do 60? I at this point, I don't know.
The thinking is that at some point, eventually,
I remember
the weight of that
you
just
and I
is
are
too
old
much.
enough to remember. Now, I'm so sorry for the younger listeners, but I got to go back even further to Bill Clinton's first term.
When did we balance the budget? Was it the first term or the second
towards
term?
the end. So in the second term, he got into surplus, but in the first term, he comes in. I think he's got the whole thing, right? He's got the full hand.
Right.
He's got a full house. He's got the Congress and the Senate and him, and he's in there. And they're going to go to town. They got programs. And the bond market says, no, you don't. And raise long-term rates. And Jim Carville, who's a very colorful, and he comes back. He says, look, I would have wanted to come back as the president, the Pope, a 400 hitter. In baseball, but actually now you want to be the bond market. It's the most powerful thing.
I want to be reincarnated as the bond market. Yeah, it's such a great.
So do the vigilantes come back? We'll see. I don't know.
It's really quite a fascinating story. I'm not necessarily a member of either the fiscal hawks or the MMTs. I think both extremes, in any circumstance, raise questions. But I have a hard point getting past all the forecasts about here are the terrible things that are going to happen from the 80s.
Yeah.
And if nothing happens in 40 years, you kind of
hang on.
It makes me say, all right, we have to break this down to first principles and figure out, why are deficits problematic? How do the negativities manifest themselves? And how can we check if we're right or wrong? What's the line in the sand that says, we got this right or we got this wrong?
You have a lot of different levers being pulled with a lot of different frameworks on how the economy runs and works. Now, to our great benefit, we're in economies, for the most part, that are dominated by free market-oriented activity, which has inherent in it a very Darwinian type of regulation. I'm talking about, like, why do economies accelerate and decelerate? So before we had policymakers, before you had the Fed, you still had cycles. Okay? It's not like cycles are new, and it's not like cycles didn't turn up and down without policy intervention. They did. So there is a mechanism under there that is kind of optimizing or penalizing decision-making. And when we look at forecasts that are made, right, what you're really doing, I think, is not so much, hey, I think it's going to be one, and it said, was I right or wrong, right? I think that's kind of a fool's game. It's managing risks. What is the risk that things are going to go the other way than what everybody's thinking? Because as a decision maker, it's easy enough to go with the crowd. You know, it probably feels less risky. Everybody else is doing it, whatever. The interesting and tough thing is when you deviate from the crowd.
Right, when you when you deviate from the crowd, there's career risk. When you're wrong with the crowd, all right, I was wrong, but so was everybody else.
Correct. And so, but now let's take this to an economy or a business, so it's policy or private business decision making. I think for an economy, you want this to be healthy, strong, growing, improving quality of life, which probably means not crazy inflation, but decent growth, which is going to be related to productivity growth on some level. And so how do you achieve all of that? Well, one way to move towards that is to smooth out the cycle a bit. Okay? Booms and busts are very, very freaky, right?
Disruptive.
They scare you, right? On the one hand, you're like, the sky is falling. I got to batten down the hatches. That's very expensive and disruptive. On the other hand, when you're in a boom, you start taking pretty crazy risks, right? Because you say, the fear of missing out kicks in, and you start to really overextend yourself. So,
and by the way, we saw that at the end of the 1990s, the 82 to 2000 cycle. We certainly saw that in a different asset class in the 2000s with houses and mortgages. And then the question is, are we seeing that today when we look around at tech and AI and things that we think are going to change the future? Have we gotten into that FOMO, things are out of hand phase?
Yeah, I think so, because let me just tell you the story of our indicators over the last couple of years, because that answers this question in a way. So the indicators, first off, they shoot up in 2020, right? So we see the short and nasty short recession we were writing about, right? And so we get that correct. And there's a lot of hand-wringing that we all felt later in 2020 and 2021. I'm not denying any of that. The indicators don't feel any of that, right? We're moving to the upside. And so they're directionally giving us this upside tilt in the way that we're looking at risk.
Separate from the way people experience it, which is after any sort of break or crash or even short reception, there's that PTSD that follows.
Sure.
In fact, we were talking earlier about the GFC in 08-09. I have a vivid recollection of talking to people in 2010, 2012, as late as 2015.
Still talking about
Still waiting for the other shoe to drop.
It manifested even, I think, maybe an order of magnitude more post-COVID from what you just described.
People did not believe the rally off of the March lows.
So two big things happen. One preceded COVID. I'm just talking numbers here. It's nothing else. But legal immigration kind of ground to a halt. During the Trump administration. That runs about 1 million people a year. So over the course of 4 years.
We're not talking Mexican border. We're talking about legal immigrants to the U.S.
Legal immigrants
with a green card and the right to work.
It's about, so you lose on the order of 4 million people out of the workforce. I mean, look, we have a big workforce, but it's a noticeable number, right?
Yeah.
And then you have COVID, and regardless of the shutdowns and this and that, a lot of people didn't come back to the workforce. You lose another serious hunk. So
another 1 million people.
All I'm describing, look, I am very empathetic to the human cost here, but I'm just saying from an economic, counting the people who are in the workforce point of view, you have a huge constriction of the labor supply.
Right.
At the same time, that PTSD and the impulse that we have as a country or people, community, is that we want to help. We want to do something. So the amount of dollar support given to the economy post-COVID is just mind-boggling, okay? Senator Everett Dirksen used to quip about $1 billion here, $1 billion there. Now we're talking real money.
Right.
We're talking trillions here, trillions there. I think it's on the order, back of the napkin, I think it's on the order of about $7 trillion dumped on the economy when you have a constrained labor supply by a serious amount.
By the way, to put some flesh on those bones,
yeah.
CARES Act 1 was $2 trillion, which, by the way, was under President Trump.
Yep.
The CARES Act 2 wasn't quite as large. I want to say it was about $800 billion.
Yeah, stimmy checks, all of these things.
Also under Trump. And the fascinating thing about those, that hit the economy immediately, wasn't spread out. Then President Biden comes in. CARES Act 3 was another $1 trillion.
Yeah.
Then spread out over the next decade, the Infrastructure Act, the Inflation Reduction Act, the Semiconductor and Chips Act.
Chips and Science.
And then there was one other, but those 4 things were spread out over a decade. So they're
still
tailwind.
Hitting. They're actually still hitting now.
Yes.
I mean, when we look at one of the, now I'm going to get in the weeds for 2 seconds. One of the cycles, because we look at many cycles on growth. So one of the cycles we look at, which we can see and track, is non-residential construction in the United States. And so that's cycling down. The leading indicators are collapsing. The actual coincident indicator is turning down. And it just does, the coincident index, which is the target, just does a hockey stick in August of 22. Because I understand that these fiscal infrastructure acts and CHIPS acts are going to come out over time. But private sector also jumps on that, right? Mm-hmm. They're like, we're going to get in on this, and we want to have access to this. So we'll put in some, you put in some. All of that starts back in the fall of 22. You see a cyclical impulse, which is to the downside. I mean, look, leading indicators of the economy turned down hard in 22 into 23. Mm-hmm. They were completely consistent with an outright recession. You had GDP.
Well, you had rates go up 525 basis
even
points.
Before the rate hike, though.
Oh,
even
really?
Before the rate hike, yes. So from
which began in, let's call it March 2022, something like that.
So before that, you're seeing the indicators already wane.
But you had a lot of jawboning. There were expectations that rates wouldn't go up.
Yeah.
Some people believed it, some people didn't. The market clearly anticipated it.
They were a little late on the rates up. The market was late on the rates up compared to leading indicators of inflation. They were leading indicators of inflation went up end of summer into the fall, and the markets started
in
to
21.
Move. Yeah, and markets started to move later and towards the end of 21.
That's right. That's right. And then 22, bad year for both stocks and bonds.
That's putting it mildly, but it was a nasty year for bonds. But okay,
unusual, by the way, that you had stocks and bonds both down double digits. I don't think we had seen that for 40 years. 81, 82 was the last time we saw that.
Yeah, that's not your typical thing. It's hard to run a system with that as a likelihood.
Right.
And I think that's why a lot of people got tagged then, understandably. But the point is, when you have that much foam on the runway, that's a lot of foam. Because we didn't even talk about the central bank earlier on. Before they started to tighten, they were very, very loose, accommodative. Right. So when you have that much foam on the runway, it was very different than what we saw in other economies around the world. And so you saw GDP actually contract for a couple of quarters in 22, but jobs did not go negative. In order to have a recession, you need to see output and employment going negative along with sales and income. Mm-hmm. And so those conditions did not present themselves. There's been a tug of war, I think, going on for much of 23 between cyclical impulses to the downside,
right,
and foam on the runway pushing to the upside.
Combined with what you were hinting at earlier, which is a labor force that's arguably 4 to 6 million bodies short.
And so you would have employers, literally, if you could walk and talk, you got hired. Right. And now I think people are a bit more picky.
Although you still hear some companies talk about labor warehousing. Yeah. Because if they have growth, right, labor hoarding and labor warehousing, if you're expecting growth, you don't know if you're going to be able to have the bodies to execute it. You hire sooner rather than later.
And hiring and firing is very disruptive for a business. So if they could see over the valley and hang on to people, they try to do that. So you see when you look inside of the different levers that employers can pull, work week, temp hires, part-time versus full-time, all these different things that employers can do. A lot of them are marginally, they're moving down. They have been moving down, but they've fallen short of outright firing because, as you say, if things firm, I don't want to be scrambling to find someone to work. And there was a little bit of a line here. The big businesses were able to hire people. There was the smaller businesses that had a really, really tough time. And they have PTSD today where they're very reticent to let people go. Again, you've got slower jobs growth, but positive jobs growth. So in the tug of war between the cyclical impulse down and the foam on the runway, we're staying out of recession so far. Now, meanwhile, we talked about the different cycles. Meanwhile, the inflation cycle downturn, which has been going on and is projected to continue and get towards 2% and hang out there, that's not cooperating, right? That has stalled out. Our future inflation gauge, our leading indicator of inflation, has come down, and it's gone sideways for almost a year. It stopped going down. So very consistent with this headline kind of statement of sticky inflation, without getting in the weeds of what's what in there. Overall, inflation is not reducing the way it's supposed to, and that could be a problem. I think that's going to be a problem this year.
So let me challenge or push back on that a little bit. In the 2010s, we couldn't get inflation up to 2000. We had a very punk post-crisis recovery, which, by the way, is not atypical following a financial crisis. You tend to have a weak-ish recovery. Combine that with mostly monetary, hardly any fiscal stimulus following the financial crisis. So that's the original framework that we came into this with. And then Roger Ferguson, the former vice chairman of the Federal Reserve, had this delightful column he wrote. Maybe it was Foreign Affairs. I don't remember where I saw it. The 2% target is hilariously made up. And it traces its roots to a live television show that it was either Australia or New Zealand that a banker had done, right? And kind of just spitballed it. And that was in the 1980s. And why are we still stuck with 2% as a target, especially when we're in an era of big fiscal stimulus?
Well,
it's kind of kooky, isn't it?
Well, it is kooky. Look, I want to step back for a second because this is the product of a model-driven mindset.
Yes.
That if you add this to that and tweak this, that we get some number at the end. And a lot of forecasting and model-driven and the way people think about the world is based on econometric modeling.
Right.
Now, econometric modeling is a very useful tool. Okay. But it can help frame, like, what are we looking at outside our window? But one of its particular weaknesses, probably its biggest weakness, is it can't handle a turning point.
Right.
Okay. Now, if you live in an environment that has upswings and downswings, and your framework can't handle turning points, you shouldn't be surprised that this thing goes awry every once in a while. And so right now, so all I do is turning points. Right? All ECRI does is turning points. So my mentor, Geoffrey Moore, was the father of leading indicators. His mentor, Wesley Mitchell, identified what a business cycle was over a century ago. And so we don't think in model terms. We're thinking in directional change terms. And today, if the model is saying we should go to 2% and hang out there, and the leading indicators of inflation are saying, yeah, it's not going down a lot, and that risk of an upturn is growing every day. The cyclical upturn, I'm not making a big pronouncement about the amount of debt out there, or is China exporting disinflation again, or anything. I'm just saying that cyclically, these forward-looking drivers of inflation collectively stopped falling a year ago and are starting to edge up. What gives me some anxiety, that doesn't give me anxiety. What gives me anxiety is that we look at this around the world, not just the U.S. So when we look around the world at inflation cycles in Europe and Asia, emerging markets, major emerging markets, we see that in this century, they've been largely synchronized. And lo and behold, all the leading indicators of inflation, the future inflation gauges abroad, are moving up sharply. So that we have an international inflation cycle upturn taking shape. What are the odds that the U.S. is going to sit this out? I'm not so sure about that. So I'm watching the future inflation gauge very, very closely.
So I really like the framework of let's look at three distinct but interrelated cycles, growth, employment, and inflation. I also have a very vivid recollection of our first interview. You said something that just stayed with me for a long time, which is recessions just don't happen when the economy is robust and sturdy. A robust economy can take a hit and kind of catch its footing and keep going. But if you have an economy that's weak, that has some structural problems, and there's an economic shock, those are the sort of setups that create recessions.
Yep.
Am I doing that any justice?
We talked about the window of vulnerability is what we talked about. And so, again, the basic structure of how we look at the economy is it's a free market-oriented economy. This is a condition we see in market-oriented economies. And they have an upswing and a downswing. And we see this in the United States, and we see this around the world wherever free markets present themselves. And recessions occur during the downswing, during the slowdown, when the economy is slowing down. And now I'm talking about a growth rate cycle slowdown. So you're decelerating, let's say.
Meaning you're expanding, but at a slower
you go
amount.
from 3 to 2 to 1% growth, something like that. So you're in a growth rate cycle slowdown. Now, if a shock hits you when you're in a slowdown and the forward-looking drivers of the economy haven't turned up yet, now that's the recipe for recession.
You're vulnerable there.
You're vulnerable. So we can have an example of that would have been my first recession in real time with Dr. Moore was in 1990. And the leading indicators had turned down. Most of the Wall Street and the professional forecasting class thought that we had dodged economic risk at this point. But the forward-looking leading indicators were turning down. The economy started to slow a little bit. And then Saddam Hussein invaded Kuwait, and you had a okay spike in oil prices. So that's the shock. And that together, and the Fed was a little tight. And so that was those combination of events, boom, we get a recession. We could see other moments where pretty big things happened, but you didn't have a recession. In 2005, I guess it was, Katrina shut down about a quarter of the country. No recession. It was a big hurricane. You had 1987 crash, took out a quarter of the market, of the equity market. Right. You didn't have a recession. World War II, the attack on Pearl Harbor, pretty big shock, didn't cause a recession. Okay, so there are these moments where what you would think would or could be recessionary shocks are not recessionary because of which way you're trending in the business cycle or in the economic cycle. And then others that seem like, okay, that's negative, but it wasn't really that big. But it turns out to be timed right at that moment of weakness. That's how you get recessions.
So we were talking about last decade. You had a couple of periods throughout the 2010s. Most recently, 2019 heading into 2020, a number of people were starting to warn about, hey, we're decelerating. We could see a recession. I want to say mid-decade, 2015, 2016, same sort of thing, a little bit of slowdown. And then 2011, there was a pretty robust consensus that we're going back into recession.
Yep.
So when I look at that decade, and yet we went the entire decade without a recession, what is it that allows those instances to avoid becoming what you taught me, persistent, pervasive, and pronounced? Are
the declines in the indicators.
The three Ps. It's not just a little dip. It's not just a sector. It's big and broad and lasts.
So there's a lot of evidence. So what I would say is in 2011-12, we had a pronounced, pervasive, and persistent decline in the forward-looking leading indicators. Okay? And you had weakness in the coincident indicators. You had a 6-month period with the weakest GDP outside of recession in the past half a century.
Right.
That happened, right? And that happens in 2011 into 2012. Now, in retrospect, why wasn't that a recession? Right? There wasn't a shock.
Right.
We didn't have a shock there. And one of the things that stood out when we did the post-mortem of that period was that it was the most stable period of oil prices ever since oil prices were fixed in the 70s, okay? There was a moment of price fixing under Nixon, okay? So since then, we'd never seen the stability in oil prices as we saw during that little window when we had vulnerability. And I think, I mean, I'm not an oil supply expert, but fracking was coming on. And so when you would have like the Arab Spring or Egypt was shut down or something would shut down and you'd have this supply shock, boom, you had fracking come step right in and be like, we're here, we've got the supply. And your prices were just rock steady. So that's 2011, 12. In the mid 2000s, 2010s, so sorry, the 14, 15, 16, we absolutely nailed that because we weren't calling for a U.S. recession then. But what we did see, and I alluded to this in the earlier segment, was about the global industrial downturn, which impacted the U.S. And
how much of that was China? How much of that was Europe or elsewhere?
It was everybody. In that one, it was everybody.
Huh.
It was China, Europe, and the United States, other emerging markets, all felt this global industrial growth downswing, so much so that the U.S. had a manufacturing sector downturn that was pretty sharp, and anybody in that business would have called it a recession for them, right? That's how they would have felt. Now, the overall economy never went into recession. We didn't call one there.
Fourth quarter of 2018, market down 20%.
Yeah.
And then 2019, following that, sort of a recovery, but people were still a little skittish.
Stay on 2018 for a second,
Yeah.
because everybody was so young then, right? We were including
pre-COVID, it was a different era,
including Jerome Powell. Okay, and so he goes out and talks to, I think it was Judy Woodruff or something, and starts talking about R star and how we're far away from R star, and he's hiking and all this stuff, and meanwhile, the future inflation gauge has turned straight down.
Huh.
It is already turned down, right? So inflation, not a problem. But this is what's keeping him up at night, enough so that he freaks out the equity market, and you get a nasty December. That sets you up for the Powell pivot in January, where he's just like, oh, yeah, screw this, I'm going to go the other way, and says, I'm going to go on a listening tour and try to figure out what went wrong. And, I'm not going to say more about that.
So let me stop you there, because you're pointing to a couple of really fascinating things I want to talk about, and I'm taking notes. I'm writing energy, I'm writing FOMC, I'm writing housing. Let's start with energy.
Yeah.
So today we simultaneously have these two conflicting challenges. On the one hand, launch of Iranian missiles at Israel, 99% of them were knocked out. Oil prices ticked up, but they didn't go crazy.
Yeah.
At the same time, I just was looking at a chart. Was it Torsten Slok? I'm trying to remember who sent it. The U.S. is now the world's largest producer of oil. More than Russia, more than Saudi Arabia, more than any other country in the world. So when we look at the challenges to energy as a shock, how do you contextualize geopolitical turmoil? By the way, I didn't even get to Russia invading Ukraine. Yeah. How do you balance all of these cross currents? So
in our forward-looking data, so I'm not talking about what's actually happening, but what are the risks of a turn in the drivers of the economy? We're looking at hard data from the government. We're looking at market data. So just what do we price something, a barrel of oil at, for example, or something, interest rates. And then soft data, survey data. And these are our sources of ingredients in a way, or consider to give us a hint about what are the key drivers of activity or separate cycles like inflation doing. We're looking at it very much from the demand side of things, okay? So if there's a supply constraint or all of a sudden the supply gets flush, then the demand is interacting with the supply to give us kind of where we are in the world. So one of the things that we've been talking about since last year is that this year we're going to see a global industrial upturn. a bona fide cyclical global industrial upturn.
Just straight up demand for more manufactured goods
around the world. And this is not country specific. It's not specific to somebody's policy or anything. It's the way the global industrial cycle works. That's cycling, that's bottoming and cycling up. And so you've seen this begin to manifest in some very short leading indicators of global industrial activity, which would be industrial commodity price inflation and in PMIs and in some of the export data that you'll see out of different countries. And those are all starting to gear. Because the movement in the forward data has been pronounced, pervasive, and persistent, this ought to keep going for a couple of quarters.
So in other words, when you look out at least the manufacturing sector, you're not seeing a global recession in that space.
No.
Which makes it harder for there to be a global recession, I imagine.
It certainly is the backdrop on which we're all operating. Let's say in the U.S. specific tug of war that's been going on around window vulnerability to shocks, the window's been kind of pushed down because of all that foam on the runway. And now, with a global industrial upturn happening, it gives some relief to our manufacturing sector, which will get to be able to gear a little bit more. And that gives a bid on energy prices, notwithstanding what happens to supply. Supply is, other people are experts on supply. I mean, we've been doing fracking for a long time. It's brought us to become the world's biggest producer of oil. I don't know how long we can do that. Maybe that peaks out. I'm not sure, but
it's not weeks.
But it's not weeks.
Years
it's years.
And decades,
it's years.
Right.
Exactly.
So then the second related question is, you mentioned the Powell pivot in 2019. I am getting the sense from reading and listening to the chairman that they're aware of the problem child in inflation is housing. They've locked a bunch of people in who have mortgages 5%, 4%, 3%. They can't put those houses up for sale because their new financing is going to be too pricey. Add to that the fact that following the financial crisis, the United States wildly underbuilt single-family homes for a decade, and you have a recipe for sustained rental prices, sustained home prices, and limited supply. How would you imagine the economy is going to respond to what limited choices Powell has in front of him?
Look, jawboning is half of the game here. And so the whole time there's been this jawboning about they missed the boat on the inflation upturn, so they had to make up for that. Right. A stitch in time saves 9. They had to make 9 stitches, right? So they put in the 9 stitches, and then now they're caught up, and they're like, okay, now we'll go the other way. We're going to do that, and the market gets out over its skis, right? The way he talked in December, I think they got 6 rate hikes priced in.
Right. So wait. So let's just look at this calendar.
Yeah.
So CARES Act in 2020, and then the CARES Act 2 and 3 and 20 and 21. Inflation spikes, passes the 2% upside target March 2021. By March 2022, it's 7-8%, and the Fed starts hiking. Ironically, by June 2022, inflation peaks at 9%, starts coming down, in part to increases, in part to jawboning. By June 2023, the Fed has done 525 basis points in hikes and kind of says, we're pretty good for a while. That's 9 months, almost a year ago. Whatever the long and variable lag of inflation is probably that rate increases have probably been felt in the economy. Now it seems that he's not going to do 6 cuts, but 2 or 3 certainly felt like they were on the table.
Yeah, so you went from 6 to 2 or 3, and then now we're taking the under on that, right?
On 3, under on 3.
I think that's where it seems to be headed, which is, again, consistent with the future inflation gauge not falling anymore, right? It's been going sideways. Anybody who's borrowing money is feeling the pressure of the higher rates, right? So you're
especially
seeing
Uncle Sam.
Uncle Sam, you got delinquencies rising from lower rates, you got bankruptcies, you got all those kind of things happening.
Ticking up, but not problematic yet.
Yeah, the levels are pretty low.
But they're definitely ticking up.
The direction is clear, right? They're moving to the upside. One of the bigger issues out there is probably all that commercial real estate stuff that's financed, and where are those walls of financing out there, and when do they have to refinance them? And so the hope is very much that rates come down before those loans come home to roost. The problem is the inflation cycle may be firming. If, for example, commodity and price inflation has a bid from the demand side. I'm not talking about the supply side.
Right.
If supply gets constrained, even more so, right? So far, I don't think we've had that disinflation from China that we enjoyed in the previous decade. Maybe that'll come back. Maybe it won't. There's some talks of tariffs, for example, and then things like that, right? So this is a very fluid thing in terms of global trade. All those supply chains, which used to be just in time, they've been hardened to become just in case, and that's expensive.
In time to just in case,
right? That's a big.
That makes
shift.
A lot of sense. Yeah.
So there's a cost when you start to do that. There's a cost. All of a sudden now there's a cost for holding inventories, right?
Right.
Last decade, it was zero financing. Now this decade,
you got to finance. You got to put in a warehouse. You have to have shippers standing by.
All that costs money, and then the PTSD on the difficulty of hiring people doesn't have employers firing people. So wages, which, let's say Atlanta Fed has a wage tracker. It had a north of a 6 handle a year ago. Now it's down, but it's down to like just above 5% increase in wages. Now that's a real number. Like that's not zero, right? That's a real number, and this will start to squeeze on margins. And we touched very quickly on AI and the hope around AI, and we're as hopeful as anyone else that it's going to boost overall productivity. But it could take a minute.
But what's the cost, right? Like every time there's a new technology comes along, the Luddites come out and they say this is the end of the workforce. And for the most part, it's been pretty easy to dismiss that sort of fatalism. Yeah. It almost feels as if AI is the first time where you have to be, hey, let's not be quite so dismissive this time. You could see how, and we all kind of laugh at Siri is terrible, and even Alexa is awful, but you could see that, hey, it's not going to be a century before the stuff is usable. It's going to be months and years, not decades.
Right, but will it happen fast enough to offset the inflation cycle upturn that's looking like it's showing up in 2024? Probably not.
I have no
sense.
idea. Right.
My guess is probably not there. Although I think we can probably adapt reasonably fast. After COVID, the remote work kind of stuck, right? People adapted to that pretty quickly.
It's funny because everybody blames COVID. All this technology has existed for a decade before. My office was doing remote work, remote offices in the 2010s. What changed was society suddenly recognized, wait, why are we going to a building 9 to 5, Monday to Friday, to sit there and do stuff I can do in my pajamas at home? I don't understand.
Well, there's a social component to it that we
There's
need
mentoring, there's collaborative work. There are a lot of reasons, but it's not 9 to 5, 5 days a week.
No.
And what you mentioned with commercial real estate, kind of fascinating that is a slow motion train wreck, because these are 10 and 20-year leases. They come up a little bit every year, so it gives the Fed and the regulators time to manage that, which comes back to, hey, I understand why Jerome Powell is concerned about reducing rates. If low rates didn't cause inflation, again, are high rates reducing inflation? I would argue not only are high rates keeping rental prices up and limiting supply in real estate, but now you have to deal with commercial real estate and the federal deficit. Like, there is a good case for him to take rates from 5.25 to 4.5 and say, let's see what happens if we leave them here.
Right. And
is that wishful thinking on my part, or is that?
I think that that sounds plausible. It sounds like everybody has pain but can kind of manage it,
right?
Which is probably the course that seems reasonable.
And it's still at a level. If there's a recession, they have some room.
Yeah. So this all seems reasonable, except that there's a cycle. Right? The cycle doesn't care about that plan, right? It's doing what it does. And, The inflation cycle doesn't go down to a number and hang out until you're ready. Okay? It does what it does. And so right now, internationally, look, we have a global industrial upturn. So that's got a bid on your industrial materials prices, sensitive industrial materials prices, energy, metals, and these things. Then you have recessions have kind of run their course. There's been
in Europe, you've had a few recessions. In China,
you've had a few recessions. So these recessions have been happening. Taiwan, New Zealand, Russia, Japan flirted with recession. Sweden and Austria,
Germany,
UK and Germany. So technically, I don't know if they went in because of the employment. The employment didn't contract there. They got the negative GDPs, but they didn't get the negative employment quite the same.
So then let me ask you an employment question here. If the U.S. is, pick a number, if we were 4 million immigrants short, we lost 1 million to 2 million people to COVID.
Yep.
So whatever the number is, there's a few million people missing from our labor pool. Is that true in Europe and in the Far East?
To a degree, they didn't have the same issues, but to a degree, it's tighter.
I mean, clearly Japan has...
Look, demographically, there's a whole other structural demographic discussion we can have where there's a hunk of people who got old, right? And then there's not as much younger people.
As tends to happen.
And there's another...
So Japan has its own specific demographic challenge.
Yeah.
Then when we look at China... The one-child policy is coming home to roost. They have an enormous shortfall, generationally speaking.
Huge. Not easy to solve, and it's where robots and AI and these kind of things have to pick up the slack. And probably the only significant place in the world that has a lot of people being born, I guess India to a degree, and then Africa.
Right.
These are the regions of the world where the populations are growing.
South America also, but not as much.
Not quite as much, right? So growth, which we all want, is really broken down to population growth. When I say growth I'm talking about growth in the economy.
Economic growth.
Economic growth is populate your workforce growth plus your productivity growth. Productivity growth, by the way, is really bad. It's really, really, really bad and has been kind of deteriorating for decades. And
which is just so stunning to me. And I imagine you also, because the work that we do, technology has been nothing but a boon, allowing us to accomplish more with less. But that's, I've figured out or have had beaten into me over the years, you're doing certain type of work that benefits from this, but not everybody gets the benefit of faster internet and quicker computers.
Information technology jobs have benefited quite a bit, and the productivity has shot up. But our economy is not simply that, right? It's much bigger, and there's a lot of hands-on stuff that happens in our economy, and we all experience it when we go about our day. And that overall workforce productivity growth has basically been suffering. Now, what happened is around COVID and in the aftermath of COVID, you had a gargantuan plunge in productivity growth. So it's stair-stepping down over decades, and it just absolutely plunges.
Really?
And then it rebounds, right?
Because I recall the initial part of when we were in lockdown and work from home, there were all these reports that were surprisingly, and again,
that's because the hours worked went down and output stayed up, so your productivity shot
and that was people who had the ability to work from home. But if you were not working from home, if you were not able to just log into your office from your computer, I have to imagine that productivity crashed.
I mean, so some stuff, like if you were doing hands-on work, you just had to stop working, right? People were furloughed, and so that output just collapsed. Now, as we open up, we've seen a big spike, and you get like positive 2 or 3% productivity growth, and it happens around the same time that we see all of the stories around generative AI. So in our simple human brains, we're like, oh, generative AI gave us this productivity thing, which is not true, right? What really happened is you had a snapback in productivity growth from horrible numbers, which were not real numbers. They were around the whole recession and COVID debacle. Now, is that kind of productivity growth sustainable? It's the only way out of this inflation conundrum that the Fed is stuck with. So currently,
You're saying productivity growth is the only way out.
at the moment, right? I mean, how are you going to pay someone 5% more but not have high inflation? For example, right? You need productivity growth.
Well, you got to go back a step. You need more employees. You need more houses. You need more semiconductors to put into cars. A lot of the inflation that we've seen over and above the giant fiscal stimulus has just been these shortages that kind of were lurking, and we really didn't pay attention to them.
Again, you're back to just in time versus just in case. And so now if a trade route gets pinched, if a bridge goes down, if somebody threatens a factory somewhere or a factory gets messed up, boom, the ripples up the supply chain. So there's probably a new structural floor on inflation, by the way. It's probably not as low as 2%. It was earlier. That structural floor is probably a little bit higher because of the more robustness that we're going to want in our supply chains. Are you talking
3, 3.5%, 4%?
I don't know. It's just higher.
But it ain't 1.5%, 2%.
No, it ain't 1.5%, 2%. The other thing, though, history doesn't repeat, but it rhymes, right? The 70s inflation stuff is interesting. Not that anything that's happening now is what happened then, but early on in that inflationary era, people weren't that pissed at inflation. They were more excited about the growth. It was that each time inflation cycled down, it didn't get down as far as it did before, so that you had higher lows in the inflation cycle. And at the end of this decade or so, where inflation went from below 3% to above 13%, it was cycling. The average was 7. It was really high.
In 1970s.
For the 70s, for that decade, roughly.
Right. But it's such a different decade compared to
Completely
today.
different. But I'm saying psychologically interacting as consumers with prices.
Right.
When the lows, when inflation turns down, but it doesn't get low enough, it stops at a higher rate, that starts to get pretty annoying.
And people start talking about it as a structural component.
They start talking about it. Look, Burns was the Fed chairman in the early part of the 70s, and Volcker was the Fed chairman at the end and towards into the 80s. And Burns gets a bad rap because he was at the beginning of this inflation era. But understand that the environment was not at all open to him controlling inflation. It was very much like, what are you doing? Don't raise rates. Are you crazy?
Right.
And then it's only towards the end of the era when Volcker kind of had some cover to be as aggressive as he was in fighting inflation. And he was very aggressive.
Quite interesting. So let's talk a little bit about predicting business cycles. And I want to talk about your leading and your coincidental indicators. Let's start with the LEIs.
Yeah.
What goes into that, and how useful are they in letting you know when, hey, a turn is coming?
Right. So the leading economic indicators are very useful in managing risk, because they're telling you what is the risk that whatever's going on now is going to change direction and go the other way. Right? So you can have your general plan. Hey, I've got my plan for business this year, and you're running it. But if these indicators turn up noticeably or turn down noticeably, then you ought to start making contingency plans, being ready and thinking about, what would I do if things accelerated? Or what would I do if things decelerated? Am I ready for that play? Am I ready to run that play as an investor or a business manager? That's the purpose of the leading indicators. Now, inside of those, while ultimately they're proprietary, inside of them are data from the government. There's hard data. So they're counting things. That's what we mean by hard data. There's soft data, which is when someone does a survey. Hey, how are you doing? What do you feel like you're doing? Are you going to buy a refrigerator? Right? They ask you these questions. And hopefully you can see through some of the biases in there. And then there's the actual price. Like, how much does a bar of gold go for? How much does a thing of oil go for? How much does the lumber go for? How much does the house go for? These are all just prices out there, stocks. What are the stock prices? Spreads in different things. So these are all different measures that reveal how the drivers of the business cycle are acting in concert.
So what's different from the LEIs to the coincidental indicators?
Okay, so the coincident indicators don't try to anticipate anything. They're just like, what's going on outside your window? So how much output, how much stuff are we making, either physical stuff or services or houses and things? How many people are working? What is the aggregate sales? Like, what's the value of everything that we're selling? And another related point is, what's the income? What are we gaining? It's the other side of the sales, right, in a way. So those 4 indicators are the coincident data. They tell you exactly how things are outside your window. The fact that there's a cycle means that collectively those 4 indicators rise together and fall together at the turning points. And when they do that, they tend to keep doing it for at least a couple of quarters.
Some persistency.
Persistency. It's pervasive. You can't hide.
Right.
It's persistent. You can't wish it away. It's going to keep happening. And it's pronounced. It's going to be big enough that it leaves a mark, either to the upside or the downside.
So coincidental will go up and down in real time. They're not giving you a heads up. How much of a lead do you get from the LEIs versus...
Oh, and by the way, on coincidental, just to be annoying here, it's actually slightly lagging.
Which would make sense. When we get government data about employment, it's telling you about last month or GDP last quarter.
Yeah.
So, of course, there's always going to be a little bit of a lag.
We have some stuff that's a little quicker, and roughly speaking, the U.S. will come out with the data a little faster than some of the other countries. But yeah, that's the coincident data. Now the lead time this is probably one of the bigger advancements since where most people think leading indicator technology lives, is that the lead times are different. We have what I would call kind of a standard leading indicator might lead by a quarter or 2.
That's a long lead, 3 to 6 months.
That's pretty good, pretty decent lead. That's more of a standard one. A short leader might lead by a quarter, 2 or 3 months. And a long leader can push it to 3 to 4 quarters. From a process point of view, we would look to the long leader for the first heads up that a turn might be taking place, and it leads by 3 or 4 quarters. So this gives us a prior view to watch the leading indicators. And then if we see the leading indicators following what the long leaders did, then we're looking for it in the short leading indicators, and then finally, sequentially, in the coincident data. I have to say, the headlines and the market tone and the market narrative lives very much between the coincident and very short leading indicators.
Right. They change it on a dime. I love just the past 12 months have been markets are going up because the Fed's going to cut. Yeah. Markets are going up because inflation is coming down. Okay, maybe the Fed isn't going to cut, but it's the Magnificent Seven. All right, maybe it's not the Magnificent Seven. Maybe it's AI. And the story,
it evolves.
Right. It's always an after-the-fact explanation that looks silly in hindsight.
So what's very interesting, right? So I've been doing this now. Again, I'm sorry, I'm in my late 50s, so I feel old. But I'm like, wait a minute, I've been doing this since 1990, real time.
We prefer the term experienced and wizened.
Wizened, yeah, definitely wizened. The pattern I see, right, is that sequential stuff with our leading indicators, long leader,
lead, short lead,
coincidence. So I'm tracking that. That's my world. I will live in that. And there's 100 indexes I'm watching for the U.S. and around the world in growth, the different sectors of growth, inflation, and employment. What I'll see, though, is that our indicators will turn, and to the extent they diverge from the consensus narrative, and that's a funny thing, the consensus narrative, right? Because we all have our own consensus or whatever. But market prices kind of give us some beat on that, and you can get some amalgamation of what all the smart people are saying, and you get some sense of what the narrative is or what the Fed's saying or whatever. Right. And when the cyclical story from these objective leading indicators, which they don't care about the narrative, when they diverge from the narrative and a gap opens up, that's interesting. That's where the really interesting stuff lives, because if there is a cyclical turn, and these indicators are, I don't know anything better to get these cyclical turns, the risk of a cyclical turn, to watch it. If these cyclical indicators are correct and that divergence has to be resolved, it has to be resolved in some way or another by the narrative moving toward
Catching
the
up,
indicators.
right.
And so I don't know exactly how the narrative's going to catch up. Maybe it's going to say housing did it. Maybe it's going to say, the Middle East did it. It doesn't matter. By hook or by crook, by the end of 2024, you're going to see, there's some demand for commodities.
Right.
Who saw that coming? And global industrial or manufacturing emergence, whatever the story is. And then, inflation didn't go down as far as we thought. All these banks around the world are banking on cutting. ECB, everybody. These people are talking about cutting.
So let's talk about those four long, leading, short, and coincidental. We're recording this. It's the second quarter of 2024.
Yeah.
Markets had a pretty robust rally to start the year, giving up some of those gains as the narrative.
Yeah.
First it was vibe session.
Yeah.
Then it's 6 cuts. Now it's 3 cuts, maybe 2 cuts, maybe 1 cut, maybe none. What are you seeing across long, leading, short, and coincidental indicators today?
For the cycle on growth, I'd say by and large, if I squint, they're firming. Okay?
Meaning doing okay.
They're doing better. This tug of war that has been going on between earlier cyclical impulse to the downside and all that stimulus that went out, the flood of
continues to go out.
The foam on the runway. We may be seeing the window of vulnerability starting to edge shut.
You sound much less recessionary than I recall hearing from you.
Correct.
A couple of quarters ago.
Correct. You were hearing correctly.
And at the same time, I'm not hearing a whole lot of optimism that we're going to see inflation fall much below where it is today.
You see, so the immaculate disinflation was the pipe dream, right? That's the one where it just doesn't seem to work that way. Look, I've been trying all my life to have my cake and eat it too. It doesn't work that way. It doesn't exactly work that way. So that's
it's
where
the flip side of the strong economy.
Be careful what you wish
that's got
for.
inflationary impulses.
Careful what you wish for.
By the way, I've had people say to me, imagine how great things would be if oil was $30. And my answer is always, no, you'd be in a depression if oil was $30.
Yeah.
Careful what you want. It's how you get there.
So, I mean, oversimplifying, you could pick a recession and squish inflation that way eventually.
Send unemployment up to 5, 6, 7%.
And do all of that.
Nobody wants that.
Nobody wants that. So we're trying to thread the needle.
Right.
I think it's an open question on threading the needle by spending over $7 trillion. That's a policy
debate,
question that people can debate. Reasonable people can debate that.
So let's stick with threading the needle, or as most people describe it, a soft landing.
Yeah.
What is a soft landing, and
what is it? Okay, so here, if people can imagine those coincident data, you put them together into an index. It has a growth rate. If output, employment, income, and sales, it's cycled down very hard into 22, into 23. I've seen the picture. It's a sharp decline, and then it kind of levels out at around 2%. It gets pretty weak back in 22 when GDP goes negative for a couple quarters, but employment keeps it from going negative. And so we've been bouncing along. Now, I think that can start to firm a little bit. If it does that and starts to move to the upside, you have a soft landing. You had a cyclical downturn in growth without a contraction, without it going negative in overall growth. And again, I'm talking GDP, employment, income, and sales collectively. There's no one statistic like GDP, which is going to define recession. And that would be a soft landing, okay? But everything I'm talking about is in cyclical terms. I'm looking at a few quarters. I have not said there can't be a recession over a year from now.
Right.
There could be. And one of the things that I'm watching for that's not in the play that everybody is waiting to see is inflation possibly turning up before it's supposed to.
Let me ask you the question that sums all of this up. You get a phone call from the White House. Lakshman, we have some questions for you about the next 6 months before the election. What's going to happen between now and November with unemployment, with inflation in the economy, and what should we do about it? How do you answer the White House who's throwing that curveball at you?
Well, let me take the first part. What's going to happen? the indicators, I could just tell you what they're telling, right? Growth is going to firm, and I think it's going to be industrial based. It will be the first thing that you see. We are going to see, I think, employment kind of hang in there.
We're still under 4% unemployment. Pretty attractive.
Because of growth firming and the PTSD all the employers have in trying to hire people. They're very reticent to fire. You might see shorter work weeks. You're going to see weakness in temp hiring.
You've seen an uptick in part-time.
You see the uptick in part-time. You'll see all those levers being pulled, but I don't think you see the firing, which is part of a recession, right? Now, on inflation, I think you have to really think about it firming and not going down. And so that's the fly in the ointment. And, an inflation cycle upturn is an inflation cycle upturn. It's not that you could necessarily do anything about it. It is what it is. It's going to happen.
You can pound your chest about it if it works out and try and change the subject if it doesn't.
I think you get in front of it and you try to frame it, right? So the whole thing is about the jawboning and the narrative. And if you're the opposition, you're going to harp on that every single day. And if you're an incumbent, you're going to say, yeah, but look at all this other stuff that's going well, where the economy's growing.
Huh, really, really interesting. All right, I only have you for another 10 minutes, so let's jump to our favorite questions that we ask all of our guests, starting with, hey, what are you streaming, what are you watching or listening these days on Netflix or podcasts or whatever?
Well, this is all entertainment for the most part.
That's fine.
Owl House.
Really?
Do you know Owl House?
No.
I don't think you would. I'm joking, Barry. This is a show. It's a fantasy show for the kids about.
I know I've seen the tile
on Disney.
On something.
Yeah, it's a lot of fun.
It's
It's really well written and nice storytelling and a group of
but your kids are older now. You don't have little kids.
I got a 9 and I have 9 and 12 and 16, and I try to keep them young.
Okay.
As best I can. They're going to get older no matter what I do.
Forget about the 9-year-old. I know about the 16-year-old.
And so Owl House and Troll Hunter, those are nice kids shows. I was impressed with how Apple handled Foundation and the Foundation
I love
trilogy.
the books, and I watched the first season. I haven't gotten into the second season yet.
They did a reasonable job. I mean, look, there's no way you can tell the story, that kind of story. It's like Dune also. It's very hard to tell the story. Or Three-Body Problem that you were talking about.
Which, by the way, they did a really good job in the first season.
Because they're so expansive, these stories. How do you put it to film? I enjoyed that. The one that disturbs me, but for some reason I watch it from time to time, is Black Mirror.
Yeah.
Which is every once in a while when I'm like, can I take something shocking? I'll watch that, and then I don't watch it for a moment because it's very disturbing. But I've been liking all of those. I mean, there's so much good stuff.
Yeah.
And some of the
there's too much good stuff. My wife and I have been saying, all right, let's wrap up. We're finishing up Curb, and it's like after we're done with this, I want to cut out TV a few days
without getting political. Something that I rewatched it with my 16-year-old was Gandhi.
Really?
Yeah, and it held up really, really well. The movie. It's 3 hours something long, but it's so interesting to see how to remember the history and then to see how the politics get in and do things.
There's been a few shows like The Bodyguard and The Diplomat that are, to say nothing of The Crown, that are of an era, and they're just so informative and fascinating. Especially, I don't really think of myself as an Anglophile, but The Crown was just one of those things where you fall into a whole nother world.
Yeah.
And Gandhi, I would imagine, is the same sort of...
Gandhi is amazing, and you're seeing it from the other side of the table,
right?
Right? So it's fascinating, and I enjoyed watching that. But, I mean, there's so much stuff to watch.
For sure.
It's very good.
Let's talk about your mentors who helped shape your career.
I don't want to leave anyone out. There are so many people.
Well,
who
Moore
are kind,
is obviously
Dr. Moore is huge. Who really was the pinnacle of my mentors. I would say others. Some teachers. Shout out to my teachers.
Yeah.
I met with Sam Lockwood, who taught me 4th and 5th grade last summer, and that was really nice to see him. And he was he loved letting me be curious. Mm-hmm. And then as I got into college and into cycles, I had a professor at Roxton College in the UK, Dr. Baldwin, who taught me a lot about politics and the civil service, the power of the civil service, which I now have come to appreciate.
Or the deep state,
the deep state. But I don't
it.
think it was so nefarious. But yes, it was definitely that they're powerful. Dr. Lorene Harris, who introduced me to Dr. Moore, to Geoffrey Moore, and then also my father-in-law, who came from a different angle, more from a financial investing angle, but very interested in economics and psychology.
Always
in
important.
The markets, which was very important.
Let's talk about books. What are some of your favorite, and what are you reading right now?
I'm a sci-fi buff, right?
Okay.
So I like the Culture series.
Who wrote the Culture series?
Ian M. Banks.
Okay.
And it's a few thousand years in the future. It's very philosophical, but it's excellent. It's like space opera stuff. It's if you like Dune and those kind of things, you'll love Ian Banks and the Culture series. And I'm reading The Player of Games. It's a fun one.
The Player of Games.
Player of Games, yeah.
Who wrote that?
Ian Banks.
Oh, same.
Ian
same
Banks.
author.
Yeah, it's a series of things. On a more practical sense, in terms of thinking, there's an old favorite that I go back to, which is called Deep Work by Cal Newport.
I recall that book for sure.
Very, very good. I'm showing my age, but Outlive by Peter Attia.
On longevity?
Yeah, on longevity.
I'm looking for the name of a book as we speak.
And then for fun, my wife does, she's a graphic novelist, Tracy White, and so I dig through her library and find things. And there's one that I love, which is, it's very dated, but it kind of does well today. It's called Transmetropolitan by Warren Ellis. It's a graphic novel, and it's about a journalist, Spider Jerusalem, and he's this funny character who's trying to speak truth to power and all that, but a great graphic novel. I'm reading this with my son. He's 12. Be Useful by Arnold Schwarzenegger.
Oh, really?
And
that looks kind of interesting.
That's pretty interesting. And it's, whatever you think about individuals, the message that he's got in that book is a positive one.
There's a book I'm looking for the title of that is a series of related but disconnected short stories. And the name of the book is Intergalactic Refrigerator Repairman Seldom Carry Cash. And let me recommend that. That's been my favorite.
That almost sounds like Doug Adams or something.
It's got a touch of that. It's not quite as absurd, but it's got just a flavor of mixed in with harder science fiction.
I'll look it up.
An element of that goofballness.
Nice.
Our final two questions, and by the way, that's a really good list of books you have. Our final two questions, what sort of advice would you give to a recent college grad interested in studying either market cycles or investing or any sort of economic research?
This goes for any kind of pursuit, let alone economic or financial research. Be sure that you truly enjoy the work. That'll make it easier to be successful, because you're going to have to persist, right? None of this is easy. You're going to have to persist. It doesn't just fall in your lap. And so if you enjoy it, you can keep doing it. That's my main advice.
And our final question, what do you know about the world of cycles, economy, investing, research today you wish you knew back in the early 1990s when you were first getting started?
Well, I think the overarching concept is you don't know what you don't know. And that's the thing that can hurt you. Probably the thing that has surprised me the most is the sheer size and extent of deficit spending. When you take a look at what happened in the 2010s, post-GFC, and then you take a look at what's happened post-COVID, we're not in Kansas anymore. We're somewhere new. It's different for the U.S. in many ways because we are the world's superpower, and we are the biggest market. So it's not the same as if Japan did it or someone else did it. So I don't want to underestimate the ability for us to do deficit spending.
Really quite fascinating. Thank you, Lakshman, for being so generous with your time.
Thank you.
We have been speaking with Lakshman Achuthan, co-founder of the Economic Cycle Research Institute and author of Beating the Business Cycle. If you enjoy this conversation, check out any of the previous 500 discussions we've had over the past 9.5 years. You can find those at iTunes, Spotify, YouTube, Bloomberg, wherever you find your favorite podcast. Check out my new podcast, At the Money, short 10-minute conversations with experts about issues that affect your money, earning it, spending it, and most importantly, investing it. At the Money, wherever you find your favorite podcasts, and in the Masters in Business feed. I would be remiss if I did not thank the crack team that helps put these conversations together each week. Juan Torres is my audio engineer. Atika Valbron is my project manager. Anna Luke is my producer. Sean Russo is my researcher. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.